Now in part 2 of chapter 9, we're going to switch our focus to notes receivables. So it's not a real long section, but we want to make sure we understand the different definitions related to note receivables. So we're going to be describing what a note receivable is, the computation of what we call maturity date, and the recording of its existence first. So here are some of the key items you want to be familiar with when it comes to a notes receivable. So what is a notes receivable? So it is when the company that we are working on the books at either loans money out to another, a debtor, or they make a sale to a debtor and say, instead of extending you an accounts receivable, we will instead extend you a notes receivable or a note. So a note, the difference between an accounts receivable and a note receivable is a note is a formal written contract with defined information on it, and it usually charges interest, which is different than an accounts receivable. So let's take a look at this promissory note. So it's a written promise to pay a specified amount of money, usually with interest, either on demand or at a stated future date. So either right now or when it's demanded or some expected future date. So the key items, taking a look here, we see the principal. So the principal is the amount the debtor is borrowing, or from our perspective as the creditor, we are the one loaning that amount out. Hence, we would have a notes receivable. The date of the note is the day the note begins. The due date is usually defined in some type of terms, the number of days, year, months, who the payee is. So we are the payee, the one who will receive the money in the future. The creditor is the payee. The interest rate on the loan. Interest rates are always stated in annual percentages. So if the note is for 1 year, we would just use 12%. But if it's for less than 12 years or more, we would need to add a time factor to our calculation of interest, which we'll look at. And then the maker is the debtor. They're the ones who owe the money. So remember, in a notes receivable situation, we are the ones extending the credit, extending this promissory note that the person, the maker, will pay us back in a certain due date with a certain what we call maturity value. So let's first take a look at computing maturity date. This goes right to days, okay? Normally, if a note is stated in annual terms, so it's due in 1 year, it would be 1 year from the date the loan begins. So July 10th, 2019, well, it would be due July 10th, 2020. If the terms of the loan are stated in terms of months, we would just add the number of months to the day the loan began. So if the loan begins July 10th and matures in 6 months, August 10th, September, October, November, December, January 10th of the next year, it would mature. But what happens when the maturity date is defined in terms of days? Well, now you have to calculate the actual number of days from the date of the loan. So this loan began July 10th. So you need to know how many days in a month there are. There are 31 days in July. The loan begins July 10th. So we would say then July 31st would be the 21st day from the date of the loan. We need to find the 90th day. So add 31 days for August because there's 31 days. Well, that's the 52nd day from the date of the loan. We need to find the 90th. So add 30 for September. So we're getting closer. We're now at the 82nd day from July 31st when we're at September 30th. We need to know the 90th day, so 8 more days. So the loan matures on October 8th. That is the 90th day from July 10th. How about interest? Well, again, remember, we always state interest rates as annual percentages. So even if your loan maturity is 90 days or 6 months, that interest rate is being stated at an annual interest rate. To compute interest, we must take the principal of the note times the annual interest rate, but that will give us an amount of interest for a whole year. If our loan's time period is less than a year, then we need to express that time as a fraction of a year. So in this case, they were looking at a 90-day loan. You would take 90 over either a year or 360 days using banker's rule. So actual days in a year are 365, I know, but in this case we're using the banker's rule of 360. And you would have to be told that so that you know. So 1,000 principal, 12% interest, 90 over 360 is how much interest would then be for that time period, which would be $30. So when we loan this money out, I forget her name, to Julie, we would know that when the note matures on October 8th in 90 days, Julie will be returning to us $1,030. The $1,000 principal we loaned to her plus the $30 of interest. So those are our computations, but let's take a look at how we record it. So notes receivable are usually recorded in a single notes receivable account. The original notes are kept on file with specific information about each one. So to illustrate the recording for the receipt of a note, we use the $1,000 principal 90-day 12% promissory note from Julia Brown to TechCom. TechCom is the creditor. They will debit notes receivable and asset account and credit sales, because the reason that this was created was TechCom received this note at the time of a product sale to Julia Brown. So Julia might have said, I can't pay you in 30 days, but I could pay you in 90 and I'll give you this note with 12% interest. And that's what companies do. Now you could see they omitted the dealings with cost of goods sold and merchandise inventory, and that's fine. We just want to focus on notes receivables here. A seller may accept a notes receivable from an accounts receivable customer to allow an extension to pay a past due account. So in this case, TechCom agreed to accept $232 in cash along with a $600 that's supposed to be 60-day 15% note from Joe Cook to settle her $832 past due account. Okay, so in this case, Joe Cook thought she would be able to pay the accounts receivable in the proper time period, but she couldn't. So she said, could you take some of it in cash and convert the rest to a 60-day note at 15% interest? And they said, sure. And that's how TechCom recorded that. Take the 832 out of accounts receivable, show 232 in cash that they received, the other 600 in the asset notes receivable. Now, the next will be what happens when the notes are honored, dishonored, and how we record interest. So take a look. Joe Cook has a $600 15% 60-day note receivable due to TechCom on December 4th. So this is kind of carrying over from what we just looked at. And so she's paying it on time. And that's the assumption here. So the first thing we want to do is calculate her interest on this $600 loan. So 600 times 15% but that's for 360 days. We want to know 60 days. Remember banker's rules. So we divide by 360-day year times 60 days, we get $15. So not only will Joe be paying back the $600 on the note receivable, but also the interest on it. So $600 principal plus $15 interest, debit cash, $615. Credit notes receivable, $600, and then we credit interest revenue, $15, because that is revenue to us for loaning money. What happens if Joe doesn't pay it? So the act of dishonoring a note does not relieve the maker of the obligation to repay the principal and interest due. So on December 4th, if Joe doesn't pay this back, we're going to credit notes receivable for $600, credit the interest revenue for the interest portion, and then put it all back into accounts receivable, debit accounts receivable. So that's what we do when somebody doesn't pay their note on the due date. We call that a dishonored note. And we don't ignore that. We just put it back into an accounts receivable situation until a new note is created or it's paid off, whichever is sooner. Okay. So we saw what happens when somebody pays it off, what happens if somebody doesn't pay it off. Well, what happens if the note begins in one accounting period and matures in another? Take a look. December 15th, TechCom accepts a $3,000 60-day 12% note from a customer in granting an extension on a past due account. So they debited notes receivable, $3,000, credited accounts receivable, $3,000. When is that note due? Well, let's calculate it. There's 31 days in December. So the 15th day from December 16th is the 31st. There's 31 days in January. So the 31st of January is the 46th day. Well, we need 14 more days, right, to make 60. So this note matures February 14th. Now think about this. You have interest happening from December 16th through February 14th because interest happens every second of every day. It's accruing. We just don't make a journal entry for it constantly. But if our year ends, and that's what's happening here, our year ends on December 31st. Any interest from when the loan started on December 16th through December 31st, 15 days of it, was earned this year and must be recorded as interest revenue this year. The customer isn't going to be paying any money on December 31st, but that doesn't matter because in our world, we look at when the revenue was earned. And this interest revenue was earned by December 31st, the end of this accounting year. So this is an adjusting journal entry. It's an accrued revenue. You learned about these in Chapter 3. So you're going to credit interest revenue this year for the $15 of interest, and there's your computation. $3,000 principal times 12% interest, but that's for a whole year. We need to know the interest on 15 of 360 days, $15. Since we're not getting the cash on December 31st, we store it in interest receivable. What happens when the note is paid off on February 14th? Well, how much interest was earned in total on this note? $3,000 times 12% interest rate. The entire length of the note was 60 over 360, $60. So the company's going to receive cash of $3,000 plus 60, principal plus interest. So you see cash is debited, $3,060. We will credit the notes receivable. It's being paid off. Reduce that. We are now receiving that $15 of interest we showed as revenue last year and stored it in interest receivable. So credit interest receivable. The remaining $45 of interest is interest that's been earned on this from January 1 through February 15th, or 45 days of interest. And if you don't believe me, take 3,000 times 12% times 45 over 360. So now we can call that other $45 interest revenue because it occurred in this new accounting year. So when you have a loan, a note receivable, start in one accounting period, but mature in another, we have to make an adjusting journal entry at the end of the first year for any interest that has been earned and stored in interest receivable. In the next year, when the loan is received and repaid to us, we'll receive the full amount of interest and principal on the loan, but only the portion of interest earned in this new accounting year is recorded as interest revenue. The other part of it, we credit interest receivable. Okay, so that's our discussion actually on notes receivables. I know it's pretty quick and short, but that is how we handle them. So your homework, your practice problems will deal with this. So we are focused on what is a promissory note, and remember what each part of it is, how we record its inception when it begins, how we determine interest on it and the maturity date, what happens if a note is honored and paid off on time, what happens if it's dishonored, okay, and what happens if it starts in one accounting year but matures in another. Okay, so I know this one was short and quick, pretty different than what we're used to, but that's all we have on notes receivables. So please post any kind of questions you may have to the discussion board.